So where do we analyze the market, the forex market? That's a good question. Where do we analyze it? So trading is not about clicking buy sell buttons on forex platforms. No, there is a, you must analyze, understand what is going on in the market, where the market is going to. Is it going to increase in value? Is it going to get low in value? There are places to get those informations from. And where do you get those informations from? Platforms like TradingView. Okay, so TradingView is going to teach you, or is going to help you. You get, it's going to help you get access to this market, see how these markets are doing. TradingView is a platform. There's an app for it, there's a site for it, but most people use it on their PC as site, all right, desktop site. So when you log on to the site, you sign up for TradingView, you have access to a lot of trading financial, a lot of financial assets, forex, stocks, crypto, etc. Okay, commodities, any of them. So when you're looking at forex pairs, currency pairs, you are you will have access to the charts to see how the price fluctuation is and everything. You learn the tools and everything. So in the next video, I'm going to be teaching you the tools to use TradingView, how to look at the market, the most basic controls you need to navigate your way in TradingView. Let's get right into it. All right, so welcome to TradingView, TradingView.com. So I have an account with TradingView, as you can see, and therefore I have access to everything. Now if you don't have account, you can still have access to everything, but then there's going to be a problem. Every chart, join, markup you're going to do, you can't access it on different devices. So when you have an account, when you log it on your laptop, you see your markups. When you log it on your phone, mobile phone, you know what I'm saying, you still see that same markup as long as the accounts are the same. That's why you need to create an account very urgently. Okay, so when you join, so as you can see, I'm logging my account King FX Premium. There is the premium account, there is the basic, there is a pro and everything. Premium is paid. It has some features which you learn later. Okay, but you should just start with the basic that is free. TradingView is free. You can access almost everything. The premium has some features that you can't, that is better than the basic. But then let's go right into what we're here for. All right. So when you get into TradingView, this is what you see. So you click on what products. See super charts. When you click on super charts, you have access to the charts. So when I was teaching you about candlesticks, this is what I mean. Every financial market has candlesticks. You know what I'm saying? All of them have candlesticks. So I'm going to teach you your way around this very wonderful app. All right, so trading view. So let's explore the app. So first things first, I'm going to show you the watch list area. What is watch list? Watch list is the place on TradingView that we keep the pairs we trade. The currency pairs we trade, we arrange it here. We keep them here. Like I said, every forex trader has their favorite pairs they trade. Okay. When I started with trading all of the pairs, 24 pairs, right? But now I focus on very few of them, which is at the time of this video, I focus on Euro USD and DXY, where you can see something like USD card and GBP USD on my charts. Okay, like this, you can see it here. It's just here for references, which you will learn as time goes on this course. But the major pairs I execute on is GBP is Euro USD. Now DXY is also for reference and also to use as an example why an opposite example while analyzing Euro USD. Okay, if you want to add more pairs to the chart, you see this plus, click on it, add symbol. You can add, just search the pair you're looking for and you see it and you choose most likely the first option because it's always come with multiple options with multiple brokers. Okay, so that's for the watch list. So a very key thing you should learn here is how to move your chart around. So you see here, I can minimize it and if I click here, it disappears, right? So the next thing is to learn how to control or move your candlesticks around. Now you see this empty space. If I hold and drag it to your left corner, it can move. So it can help enable me go back in time like this.
to see any information I want to see or go forward to seeing it. Right? That's one very good control. The next one is this place you see numbers. 1 point this, 1 point that, all of them. See right now means you can see that it's movable and it's in this direction up and down, up and down, up and down. This is used to like expand the chart vertically or shrink it vertically also. These are just adjustment areas. Then the next place to look at is this bottom. You see the dates 17th, 18th, 19th, 20th, 20th are all these dates. So price can shrink left, right, right. So what do we need to do to adjust the chart to we want? These three controls, both the middle, this one, and this one. So basically, I can do it like this, shrink it so much that I can see everywhere. And if I want to zoom any parts of the market I want to zoom, I can start zooming in from these controls here. I shift it up a bit, go again, shift it down, keep doing until I'm seeing the perfect area I want to see. Okay, that's how best do it. Very easy. So make sure you practice all of these you're learning. The same thing on iPhones, Android, the same control. You use your thumb to do it, not the trackpad or mouse this time. So there's no difference with device. Okay.
Tools. Okay, so we have the line tools. If you click here, you'll see all the tools in the categories of the line. All right, so you see the trend line, the arrow, the ray, info line, extended, all of them. The most used tools are the ones I start like this: yellow, 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 yellow. Okay, these are the most used tools. Is it good enough?
Mm,
Yeah.
yeah.
These are the most used tools. That's why I started. This one I used most. Some people use some others, but I'm satisfied with these ones. Right? I start them. If you start them, it's going to add to your favorites. Okay. So if you turn on your favorites here, you can see the star. You see them here. So you can easily choose. I can easily choose my favorite tools here without going through this place. But I'll still show you all the tools I like. Right? So here is the next category. This is the Fib category. Okay? So I'll teach you about Fibonacci as we go on in this course. Okay? But Fib retracement is my favorite tool in this list. I don't use any of this. Okay? But this is the most important right here. The third side we have brush. Okay, so in the brush section we have brush, rectangle. I love using brush sometimes, so let me just add it right now. It's my favorites. So brush, rectangle, circle, ellipse. I use curve sometimes. And it's my favorite. So the rest of them I didn't mark. I don't use them. Okay, I don't use them. But then these are the tools on that. So this is a text tool. I make use of the text here only, and maybe sometimes the call out, comment. If I'm trying to make an illustration on my chart. So I'll show you how to use one of my best tools. Okay. So this is the patterns X, A, B, C, D pattern and the rest. I don't use any of this. I don't treat Elliott. I don't use Elliott wave patterns straight. People that use Elliott waves strategy are those that know how to use this. Though I don't use this. So let's go to the next. The next is forecasting and measurement tools. Forecasting and measurement tools, long position, short position are the most I use here. I don't use any of this. Okay, so why do I use these two? These two I use in predicting where the price is likely to go. So if it's likely to go up, use long position. In Forex, buys, long, synonymous, similar, for the same purpose. They mean the same thing.
Right, you guys, this is another video, and in this video I'll be talking about candlesticks. Okay, candlesticks. So here we go. Candlesticks. So what is a candlestick? You know what a candlestick is normally in Forex. I'm not going to talk about what a candlestick is in Forex first, but you know what's the candlestick normal. Now, candlestick looks like this. Okay, this is a candlestick. In real life, a candlestick do not have wick under, right? But in Forex, it has wick under. Now, in Forex, we have two type of candlesticks. We have the bear candle and the bull candle. I'm sure you've watched the video when I discussed about bull and bear. Okay, so in this video, at least we'll be applying stuff like that. So bull and bear, right? Bull and bear. Okay, so now we have the bull candle and we have the bear candle. Are they of the same colors? Always no, they are different in color. So I'm going to make this one the bull candle. The bull candle is mostly green. Now all these things depends on what you like. Most people always always customize their candlesticks. They look differently, but the bull candle always carry the lighter color, red, sorry, blue, green, and shit, right? White and white also. Why the bear can always carry dark color like black, red? Okay, so or gray. Changing the color of this guy. Right, here we go. This is a green and this is a red candle. Very beautiful, very beautiful. So we're going to be talking on how what are these candles. Okay, so the bull candle is actually known as also the bullish candle. If this candle is formed, or I don't know how to call it, but okay, let me start this way. I want to do it, I want to say things in a way I know that, okay, it's the least level simplicity. Okay, everybody watching this video as beginners will learn to understand. So first of all, I'm not talking about what these candles, what they do. I'm going to label two different candles right here. One is bull and is bear. We're going to be labeling them. And okay, so in forex trading, what is candlestick? Now candlesticks were used back in the years by Japanese um, traders. When I mean traders, women, rice markets traders. They use the candlestick to actually track down the records and history of price of rice and whatever. But this was employed in the financial markets, stocks, forex, crypto. The use of candlesticks to read charts. Remember when I taught you about in I think the last three videos something about economic charts, concerning economic charts. Yes. Now, what is used and what is most preferred and what's most respected in the financial market is the use of candlesticks to make up the charts. And what are these candlesticks? These candlesticks are these bull candles and bear candles, combination of them to form candlesticks. And now, bull candle and the bear candle is not the same. But even if they have some similarities, now both of them have wicks. They have tiny strokes on top of their head and below the bottom. And one thing I want you to pay attention to is the opening and closing. How does a bull candle form? A bull candle forms this way because it prints, right? It prints on the chart. Now, if you look up my background, right? Look at this point, you see 1M, 3M, 5M, 15M, 30M, 1M. 2H, 3H, and the rest to M. This is months, 1 month. Monthly time frame, weekly time frame, daily time frame, 4 hour time frame, 3 hours, 2 hours, 1 hour, 30 minutes, 15 minutes, 5 minutes, 3 minutes, and 1 minute. All these things are different time frames in the market. Now, different time frames is not really in the market. All right. So right here we have similarities. Okay, this little stuff on it, I've told you guys this is week. Now, I want you guys to pay attention to this closing and opening of these both candles. They are interchanged. Now, I let me go back to this. I was talking about this time frame. On the charts, we have what we call time frames, meaning at what time frame is this? Are we viewing this? That time frame. At what time interval? And this time interval is marked out by candlesticks. So in a 4 hour time frame, which is this, I click it, my charts will change. Okay, not my drawings right here. So let me try to shrink this and show you what I mean. Now look at my charts. Okay, now I'm going to change it to candlestick. Bam. Look at my charts. Okay, it's looking like this. This is a 15-minute chart active. If I put it in 4 hours, it changes. As you can see, it changes. This is what is happening based on the 4 hour perspective. If I zoom in, you can now see candlesticks arranged. Can you see it now? Like, look at these candles, green, black. The green candle here is the bull candle, the black here is the bearish candle, bearish, bullish, bullish, bullish. These are the weeks I was telling you guys about, right? These are the weeks, this long thin lines on the head of it. So at every time frame, it's different. Why is it different? Because in a 4 hour time frame, it takes 4 hours for this candle, each of the candles to completely form. So when 4 hours does not elapse, you see that the time is counting. Once price is on, like once market is open, like right now, market is closed, this is a Saturday. Once market is open and you see a price, a line, they call it price line, will be wherever the candle is forming. And you see the candles, they don't form in a definite manner that, okay, it's going to be red, so it will just keep going straight form. No. It dances. This red candle was once green, dance, go down, shift up, go down, shift up. Once 4 hour elapsed, boom, it stops wherever it was still forming. Like that point, it was still going over forming. And immediately it pauses at any level it is, and then a new one forms. Keep dancing, keep dancing. Once 4 hour elapsed, it pauses and that one forms. It happens on every time frame. In the 1 hour time frame, it takes 1 hour for each candle to form. In the 15 minutes time frame, which I was before, it takes 15 minutes for each candle to form. Let's go back to our drawing. Now, so now you've understood that this candle forms based on time frame. So you see this bullish candle. This is how bullish candles. This is how they form. They form in an upward direction. When they are forming, they form like this. They are playful. Like every candlestick is playful. It can keep doing as if it's going down. While it went down, it went to through this week. The more it fakes you and do as if it's going down more, the more it's going to through this long black thing called week, right? But you cannot know the true candle, whether it's going to be a green or a red candle. Well, you will only know the true candle after it has finished forming. But how does it form? It forms like this. Like this. Then later, once the time frame elapses, it stopped there and that candle forms. So this is the opening price. This is how bullish candles open. They open in the bottom and they close up here, meaning anywhere it ends. It must not be up, it might be like this. Then there's a small green candle, there's a big green candle, a very long one, it's a very short one, anyone. Wherever it stops playing, that's where it stops. Once the time elapsed, it stops there. That's the closing price. Now, this is the same, almost the same thing for the bearish symbol. This is a bear candle. It signifies a down move, right? A bear candle signifies a down move. So it takes this down move, right? This move to the downside. Okay, so this is where price opens and it keeps shaking. So when the time frame elapses, it forms there. So it opens here literally and closes here. So that's about candlesticks and how it works. So It takes multiple green candlesticks to form an up move and multiple red candlesticks to form a down move. This is how candlesticks are, right? So we have some actually crazy candlesticks. Let me just show you guys again the markets on the app. As you can see, when price is going down in the downward direction, it comprises of many, many red candles. I customize my own to be black and my bullish ones to be pink. I like it that way. Okay. Anybody can customize theirs, but the lighter colors are always the bullish ones, right? So we have see red, red, which is black, black here. Black, 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 bearish candles arrange themselves. So when price is going down, it's all bearish candles you see. When it's going up, it's all bullish candles you see. So I'm going to expose you guys to some, I think to some very to a very important candlestick pattern. I don't really believe in candlestick patterns, trust me. But these ones I'm about to show you are kind of important just for the sake of knowing knowledge, right? So we have two candlestick patterns I want you to learn. There's so many of them. There is hammer, three soldiers, there is what do you call it? There is a whole lot of candle patterns. And funny enough, I never crammed any. There's hammer, candle, battered hammer, shooting star, morning star, evening star. There's so many candle stars, but whatever I'm giving you in this course is everything you need to be profitable. I'm giving you everything I know and everything I'm using. So I won't put out anything here I'm not using, any relevant shit I won't. In fact, you won't find me doing it. Even the least Fibonacci, you won't find this in this course because I don't use it. So why will I waste my time talking about something I don't use? That's deception. So everything I do here, everything I trade, that's what I'm exposing to you, right? So this is the two candlesticks. Like it's not like I use them, but I think you should know them. Just know them, right? You have the Doji, which is this, right? Doji is spelled as. Trust me that there's inverted gravestone Doji and there's gravestone Doji, and it's not a big deal. Why I want to learn about is that this candle signifies indecision in the market. So when it forms, it's like buyers and sellers are the peak of struggling. You always find this kind of candlestick when you want to see a reversal in trend. So trend is falling, 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 falling. When this thing forms the next time, sometimes you see price are going back up. It's more like an exhausted um, group of investors, right? So in the forex markets, when you see a doji, it means maybe sellers are tired and the buyers are struggling to pick up from there. So don't use it as well. You can just use it for knowing sake, but using it to place a trade is just very, very funny to me. So now this is engulfing candles like this. The word engulfing, no cover, right? Overshadow, cover, overshadow, cover, overshadow. And here we are engulfing this big arc candle covering this overshadow is call this engulfing candle. The same thing. This could be green, this could be red, anyway, but they are mostly. But once engulf is this one will be very bigger than this one. So are the two candlesticks, I think. So here, if the red one is kind of engulfing the green candle, you can see that there is a bearish force in this market. If you have the red one, um, green one, engulfing the red one, you could say there is higher buying pressure in the market. That's all for candlesticks. See you guys in the next video. Love you all so much. Thank you for choosing Blue Kings.
I just understood that you want me to explain the idea of this charting and everything, which is in that economic this thing, economic charts, right? That topic I made. Now, listen carefully, get it right. Now, if you look at this interface you're seeing on my screen, look at it very, very well. Okay, this is Trading View. Trading View is a software on phone, an app rather, on our phones, and on the computer you can download it as an app and you can use it as desktop sites. You get tradingview.com. So I'm using it on desktop. Most traders use it on desktop, so tradingview.com. And you'll soon reach the video that will teach you how to create an account with them, and gradually you learn how to use all the tools in it. You cannot learn how to use all the tools in one night. Okay, but you just from from topic to topic, you will learn how to use some of the tools you get. Okay, but today we will learn some tools, right? But I'm not going to teach you how to use it yet because you're going to get confused. So look at this platform very well. You see this horizontal side that is showing June 1, 2, 5, blah blah blah. That is showing dates. Now look at this place too that is showing price. Okay. Now look at what is displaying here. See my pointer GBP USD. Now the whole idea of this chart is this. This price line is not showing. Let me put it in dark mode so that it can show using dark. Alright, good. Now look at this very well. There is this green faint line you can see right here. I don't want to put my pointer on it. Can you guys see it? That is somehow dotted. Can you guys see it? That is connected to this place written as 1.25141. Can you guys see it? If you can see it, just raise your hand.
Yes.
Okay, nice. So, okay. So that line, what does it mean? It means right now, as we are speaking, £1, this is GBP USD. It means £1 is equivalent to $1.25114. Okay, just like I would say one, one, just like I would say 500 naira is equals to $1. That's the same thing we are saying here, the same idea, but now this is between pounds and dollar. Okay, GBP USD means £1 is equivalent to $1.25115. Now that is what it is. If I put my pointer on it, you find out that if you trace it to this horizontal side, you will see something. What will you see? Look the horizontal, that bottom side, you see something highlighted. Monday 12th June 2023. That downside is to highlight the particular time this is happening. Now I know you see 3 o'clock PM there, that's 15 o'clock. My trading view is not set in Nigerian time, okay, it's set to Eastern time, which is the time that Canada and US, New York use. Okay, so I'll explain why it's that way. Okay, but for now, just understand that it's time. What you see down is time. What you see at the right hand side, the vertical level, is the price, and it's in USD. That's why you see USD at the top here. Okay, so what this is currently, what is this thing is this is showing us how much £1 is in dollars. Now, all this movement you see down here, when you saw this thing up here, let me, can I just, I don't want to lose my format chart settings as well. It's good. My eyes have mastered it. When you see this, when you at this point when price was here, this level, it means that as at this time, £1 was equals to what you see at the extreme right now. That is highlighted black. What you see at the extreme right, highlighted black, $1.25948. £1 is equals to $1.25948. As at what time? Monday, 12th June 2023, which is today. What time? 7 o'clock Eastern time. In Nigerian time, that's around 12 p.m. or so. That's the meaning of this. Now, can you see that between that time till now, the price has dropped? Meaning, if this thing is, doesn't mean, it means GBP USD is strong. Now, it's just like this. I'm going to use another instance to show you guys something. The whole logic is it's not hard, it's very easy. Now, when you see this, let's assume this thing I just drew here, this thing and this lines I drew here is representing GBP USD. Once you see these candlesticks, just like as you see these candlesticks line up together, when you see it trying to go up, pointing in direction going up, or trying to, or it's just starting, you know what it means? it means that GBP/USD is getting stronger. GBP is the base currency. It's what we are seeing. This action we see here is called price action. This price action is explaining what pounds is doing in respect to USD. So when you start seeing this thing going up, whenever you see it go up, it means GBP is strong. And whenever you see it going down, it means GBP is. Now, does it mean GBP itself in the country is weak? No. It means it is getting weaker than USD at that particular point in time, because like I say, this chart is showing what GBP is doing in respect to what USD. So when you see it coming down here, it doesn't mean in reality GBP is weak. It just means at the moment, if you are comparing GBP and USD, it's weaker than USD. At this moment, it's coming down. Do you understand? When it's going up, it's stronger than USD. It's getting stronger, it's increasing. Yet when it's coming down, it's what? It's weaker than USD. I hope you guys get this part. Now, the next part I want to talk about is the idea of buying and selling in this market. Okay, the idea of selling is this. What wants to join? The idea of buying and selling is this. Go back to my chat. The idea of buying and selling is this. What's the idea of buying and selling? Is that if I find out, listen, if I find out that this market or this currency pair now is about to increase in value, like I just told you that if this is increasing in value, it means GBP is getting stronger. Let's say I've analyzed everything, drawn my lines and everything, which you guys will learn later, and I find out that GBP is going to get strong very soon. I'll do this. I'll open this place here. You see two things here: long position. You see the other one, short position. If I click on it, there are two different things. Okay, so look at them carefully. One of these box has the blue up and the red down, and this other one is the inverse, red up, going down, the inverse. Now this one is used for buys. When you're anticipating buys to happen, what do? You take this tool and place it, making sure your the middle, the middle line here is matching with this particular line. Let me put this back in dark mode. See this line, this faint green line. You want to make sure at that moment this your stuff is matching with it. Okay, so let me get it back to white. You guys want to make sure it's none of that line. That line is called what? Price line. Okay, market price line. Just use the word here, market price line. That's the name of that line. So make sure it's in matching with market price line. Now, what's this red place for? Like I told you guys, if price you anticipate this thing is going to go up, your work is to click. See this button here, buy. Now, this button will not work for you right now. You know why? Because we don't place orders on trading view. Okay, we don't place orders on trading view. What we do is we place orders on another app called MetaTrader 5, which you guys will learn. But for now, don't download it, don't do anything for now. Okay, I know why. But what do we do? When we anticipate that GBP will be stronger than USD in GBP USD, we actually put up this thing here. Now, this tool is like marker. Okay, when you put up this tool here, you go on the other app to click buy. This tool is a marker. Why? How is it a marker? Let me accept this guy. I think somebody can try to. Okay, let's continue. It's not here again. How is this tool a marker? This tool shows you the stop loss area and the take profit area of your trade. Okay. Now, what's okay? This red area is like a particular point that you marked in the market that if price gets to this level, let my trade stop running in loss. So basically, if you put this thing here, it means you've clicked buy, and before you make profit, this market has to respect your anticipation, meaning it has to keep going up, up, up. Okay. What is beginner class? Can you hear me? Hmm? Chinedu, can you hear me?
Yeah, yeah, dude, what's up?
Yeah,
Good
I'm
evening.
fine. I'm fine. It's beginner class. Join 9:30.
All right, all right.
So back to what I was saying. This particular area for us to how would I call it, anticipate buys, it means, listen carefully. Oh, it means that as we click our buy, we expect it to just keep going up like this. So now if it disobeys and now start going down, what happens? We lose money. Okay? If it obeys you and now start going up, you will make money. Now let's talk about it first. If it goes into this level, your trade will be showing red, meaning let's assume you risk $50 on that trade, which you will learn how to do. Right now, you can't. I'm not going to teach you such calculation now. It's kind of going to confuse you. But let's assume that you saw a trade opportunity for this thing to buy up. You've analyzed and everything has told you that it's going to go up. And then, do you know what you will do as a forex trader? You will what? Apply a risk to this thing, and you will learn about that in the next class. Now I teach about lot size and everything. You attach a risk to this thing. Okay, that risk you are attaching to this thing is going to teach you how you're going to set this green and this red part in your trading view. Okay, well, let's assume you're risking $50. When this thing start going down against you, to start showing -10, -20, -30, the more it goes down, the more your money goes deeper in red. So you if it gets to $50 money, because you already calculated it and set up your risk, that once this thing gets to the end of this red box, your MT5, like your other app that you place the order, will be showing -$50 by then, and it will automatically off. Your trade automatically stop running. Now, why is this important? These markets are never 100% predictable. That's why we are not here to gamble. We are here to learn how to trade. Meaning, you will lose sometimes and you will win sometimes. Now, the beginner traders that don't have mentors, that nobody is teaching, and they try to jump into trading because everybody else is doing it and they think they will become millionaires from it overnight. They did not learn risk management, which is this now teaching you right here. They did not learn that they can risk a particular amount of their money. They don't know. So do you know what they do? They don't know how much they are risking. They enter the trade, and the more it keeps going down, whatever figures that they see that in their red is unaware to them. Like they don't know that price my account to go low like this. So because they don't know how to control it. But now you're in this academy under me, I'll teach you how to control it. Meaning, in Forex, you will never lose what you did not intend. Don't listen to anybody lying to you. You will lose your house, lose your car, you will sell everything. Fucked up rubbish. It's only crypto investing that I know. I don't know about crypto trading, but I know that crypto investing, you can buy a coin and leave and you wake up tomorrow and see zero naira. I know it's possible. But in Forex, there's nothing that is happening if you don't press either sell or buy. Your money is not shaking. It is where it is. If you decide that you're not trading for the rest of the month, nothing is touching your money is there. Only when you decide to come and click sell or buy. So there must be reasons for you to click sell or buy. If you're anticipating this will go up, okay, this beginner class, you come back 9:30. Can you hear me okay? Okay, are you there?
Yes, sir.
Yeah, this beginner class. You come back 9:30.
Okay, okay, okay.
Alright, bye bye. So as I was saying, uh as I was saying, when you risk that particular amount of money you want to see, what you that's why they call it what you can afford to lose. Okay, the end, your trade automatically stop running so that you will not lose more than what you budgeted. But then if your trade start going up in your favor, that $50 you risk will not be lost. again. Rather, you risk $50, meaning the more it keeps going up, the more your money keeps multiplying. So the higher it goes, it will be reading 50, 70, 100, 200. The higher it goes, the bigger the money. But you see, this your loss, it can never go higher than what you risk. But use your profit can go as high as you want. It depends on how long you leave it and how long the market is favorable. Okay. So what I'm basically teaching you is two things. I'm basically telling you that number one, in forex, the losses don't take you unawares. A professional trader knows whatever he wants to risk and whatever is going to leave his account if the trade does not go well. So he doesn't take it unawares. It's something that he's based on his risk appetite. That's one. Second thing I'm teaching you here is this tool, the usefulness of this tool. This red side is called the drawdown area. Here is the profit area. If this thing runs to the end of this thing, it means your trade is automatically off. That stop running and you ended it. If this thing ends, if this thing goes to the extreme end of this area, it means your trade is in profits. It means your trade is in profits, and it means your trade is in it means your trade is in profit. And if you get to the extreme end, the trade will close by itself and your profit will be saved. Your balance will increase. So now in forex, we increase this guy, we make sure this guy is at least two times the red side. Okay, at least the distance between this middle and here is at least two times this red side. We make sure it is. How are we going to be sure about that? If I click on this, you see risk slash reward ratio 2.03. Where the 03 added here, this main first number is what we care about. Okay, so the valuation risk to reward ratio is 2 point something and above. When once it's lower, it's 1 point something or so. No, it's wrong. Because we want to make sure that anytime we place a trade, we win at least double of what we risk if it goes well. So that when we come tomorrow and lose, it will not take all our profit away. Example, if you take 10 trades, for instance, to draw this in 10 times, it's going to take my time. Now just close your eye and imagine this. Okay. If you take 10 trades and all of them you risk $50, okay, for those 10 trades. If you lose five of the trades, out of the 10, you lost five. Since each of them you risk $50 for it, if you lost five, it's $250 loss, isn't it? Now, if the other five you won it and you made sure that all of them ended in $100 profit, since you want the profit side to be two times your loss, okay? The other five ended with $500 profit each of them. So five of them will amount to $500 profits. Then your losses amounted, all your five losses amounted to minus $250. So by the time you balance everything, meaning all the you do 500 minus the losses, you go home with $250 profits. That's why we make sure our profit is double the times, because we know we will not win every single day. And then we know that sometimes our losses and our win in numbers can be equal to each other, but we still close profitable. So that's the meaning of it. So this tool here is just a marker. Now when this thing is going in profit like this, I see it. I think that it's showing that this place now is showing that okay, it's going in profits. As this thing is going higher in profits, it's indicating that our money is increasing. So we use this thing here just to mark where we entered from, where our stop loss is, and where our take profit is. So that we can go and copy it in that our app that taking the trade. Because that other app is on our phone. The app is meant to place a buy or a sell. And see this place we call take profit side, the extreme end of it is highlighted here in green. The price is highlighted here in green, which is 1.21166. On that our app, we'll go there and input that number inside. There's a provision for it. Because you don't expect you just click buy in another app and if price runs to this level, that app will automatically close your trade. It's not possible. There must be a connection. So you copy this price here, 1.2166, go there and put it in the space available for take profits level. This place, this stop loss place too, 1.1 set in red, 1.17081. You copy what it is and go back to that app you get, or yeah, and copy it in the stop loss area. And when you copy in the stop loss area, what would that do? That would actually actually save up
that if this trade decides to go against you, you will not lose all your capital, you lose only that part of it that you decided to risk out. So once if this thing goes against you, pam, hit this place, on that app you lose, but then it's what you afforded to risk. Okay, so if you risk anything bigger, it's you that chose it, keep taking you unawares. So you learn all about that soon. But what you're basically learning here now is this tool. You have known the idea of take profits. It's written as TP. Most times TP is take profits, SL is stop loss. Okay, this down place here is your stop loss. That the extreme end is the stop loss. But when price is approaching it, your trade will be showing red. Then here is the extreme side is your take profit. When approaching it, the trade will be showing blue. Mhm. See our channel. Let's look at the channel. Let me show you guys something. Okay, so this is your colleague. This is what he made this month. So it's a small account, but let's see what it looks like. Now this app is the other app I was telling you guys, known as MetaTrader 5. Okay, MetaTrader 5. So that MetaTrader 5 now, what what do we do on this app? Is the app that you normally click your buy and sell. So you see it's trading Euro USD. Can you see it? And you see very close with buy he bought. Forget about this number you see here. We'll learn about it later. You know what it means. But focus on the pair. Forget the M you see around here. M stands for mini. Okay, mini. It means something different. But then just forget about it right now. But this is Euro USD. Buy. He took a buy. Now here showing blue. $5.48. Whatever number is here is in dollars. Now, beneath it has the date and the time. This is 1st of June 2023. This is the time. I get me. It happened. To 2 Nigerian time, 2 p.m., almost 2 p.m. Nigerian time. Get now. He took that trade twice. So that's why he's making this amount. That's two of them together is $10 plus. Okay. Now, what I want you to focus is I think that is colored blue means it's profit. Now, when you see date on that, it means his trade hits this level. See this level, his trade hits there, just like this one now. His trade hits there. So it's saved up there as profit. Do you get? It's saved up there as what? As profit. So let's go back there and look at it again. Let's go back there and look at it very well. It's saved up there as profit. This. That's why it's showing date under. If it has not saved up as profit yet, if it's just in this blue place, do you know what it will be showing like? It will be showing blue, but there will not be date under. Date is like this is your statement, your income statement, just like when you're giving you bank statements, you write date and everything. That this one is to once the profit has hit that place, it will now be added to your balance. If it has not hit there, it's still showing blue. It will still be fluctuating. $2, 3, 4, go down again, go up. But once it saves up there, it becomes static and it goes to your balance. Okay. Now on this day he lost 9 cents, 90 cents, and here is 73 cents. Now go up to $1. So I how it looks like. Sorry guys, let me accept this guys. You know how it looks like. Let's go back there again. You know how it looks like negative red. So this is how it shows when you are in this red side. It's going to be showing negative. And if you now hit the end of this place, what will you now show? To show negative and date. It will not be deducted from your balance. Okay, Kiddy, what's up? Kiddy, can you hear me? Network. Hope everybody's hearing me. Kiddy, can you hear me?
Yeah, I can hear you. I can.
Okay.
Yeah, I can hear you. I can hear you.
Please beginner class. Join by 9:30 or so.
Okay, 9:30.
Yeah, or when I tell you guys to join anytime, but for now, they're still learning.
Okay, no problem. I can still be here. I'm not doing anything. I can still be watching.
All right, no problem. So, as I was saying, that's the whole logic about how this thing works. The green side is the profit side. The red side is for the drawdown. If you hit the extreme,
what happens? Your trade close, you lost. If you hit the extreme of his, your trade close, you profit. Make sure it's two times here at least. Some traders make theirs very long. Making it very long is that the more the price travel higher, the bigger the money. Your money will keep multiplying. But there's also a disadvantage to it. Disadvantage to it is that this might not make it to the end. It might go up small and then so you want to make sure you take off the money that it shows you gives you off the table before any bullshit happens. So me, I make sure it's just two times this place. I'm not greedy. Some traders really like it high. So everybody like what they want. Knows what they want and they do what they have to do. Alright. So there's somebody asked me something now. Why does it not move straight when it's moving up? Why is it moving uh like waves, pull back? It's just like when you're trying to breathe in, breathe out, breathe in, breathe out. Okay. So now it's the same kind of thing that happens right here. Remember, these markets are not being moved by we, the retail traders. That's why I thought you will move the market, forex markets. That when I start seeing certain things like market makers, you will not be like, what is he saying? Market makers, hedge funds, they are the ones that are moving this market like this. So, you know what they do? When they buy here, listen carefully. Remember, this market was made available to you so you lose money. They don't love you like that to make such a market that will make you help you make money. No, they don't like you. They don't give a fuck about you. So it was made for retail traders to lose money. Now, it's not like they're scamming you of your money. No. Forex is so hard that if your mind is not in check, if you're not a stoic person, you will never make money off it. Okay? You will never make money off it. What I mean by stoic person is this. Okay. What I mean by stoic person is this. Now, before I became profitable in Forex, this is what I used to do. When I lose first time or I lose my trade, I get very sad. I try to make the money back. I revenge. I lose even more. I get more sad. I increase my risk so that I can make bigger profits, recover the other ones. I go in again, I lose even more. I get frustrated. I blow my account. Now, this is normal psychology for every human being. You're doing something and it's taking your money, you're feeling bad. I I want to get it back, and you encounter more losses just because you were doing what a normal human being would do. So this market now is like behaves opposite of the normal human psychology. That's why I say it was made for you to lose money. They're not trying to take your money. Nobody is looking for it. Your money is too small. But the how it works is designed to make you very emotional. And as a normal human being, it should happen to you. But now, before you get profitable for it, you have to train your mind to be very disciplined. Now, before I started making money, do you know what I did? I had a particular currency pairs I work with. Now, if these pairs do not give me a setup, an opportunity, which you guys will understand later, if they don't give me opportunity, I will not trade. If that day was a heavy news day, like tomorrow is called CPI, Consumer Price Index, it's a very big news event day. If you're trading and by 1:30 you're still in the market, spike meets you to jump your stop loss and blow your account. This thing will not save you. See this thing you see here that we're discussing about. This place I say that if price gets here, your trade automatically cuts and you lose what you risk. Yeah, by 1:30 tomorrow, this thing will not save you. This thing will go down. Now let me show you an instance where it happened so you can understand what I mean. Show you an instance where it happened. I think 13th of not 13th of every month. Go to 13th of 13th of May. Okay. Okay. That thing happened on the 11th, Thursday in the month of May. See this long candle that happened first from up to down. When did it happen? 9 o'clock. Maybe it's not CPI. Okay, around 8, between 8:30 9 o'clock. Yes, 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 Eastern time. Yes. Not Nigerian time, oh, but in Nigerian time that's around 1:30 p.m. Mhm. That's when this thing happens. Now, see how big this candle is from here to here. Meaning it will, yeah, if your stop loss is like here, it will jump it because it happens really fast. The thing that controls that your stop loss now is an AI robot. Okay, so the news effect is faster than the robot can catch up with. Before the robot automatically off your trade, this shit is already here, and this should give you 3 times what you risk. Like if you take out at least 3 times what you risk from your account. If your first account is a small account, all those $20 for your right to blow it, your money will disappear. When you have blowing of account, means your whole capital is gone. Now, this would not happen in 1 minute. It will happen in 2 seconds, 3 seconds. Everything is over. So, what do I do now? If you are lucky and you were selling, remember I told you if you're selling, it means you're anticipating a drop. If that time you were selling and this thing happens, eh, you have fast profits. So in a second, you can get, if your account is small and you're risking big, you can get 6 times your whole capital. Boom, you get in just 2 seconds. You see. Yes, if you're selling. But now, in as much as you don't know where that spike will go, up or down, what do? You stay out. Okay, a lot of new traders don't make money by all costs. So they try to be involved with it, hoping that it goes their way. But then, such kind of event that will not respect your stop loss, why are you risking your hard earned money right there? You cannot turn to a millionaire in 1 day with $20 account. You can't. Okay? So what happens is that I started developing discipline. On these days like this, I'll stay off the market and do another thing in my life. On days when I don't understand what the market is doing, I will not involve myself. So I remove my mind from trying to make money and put my mind on perfecting my skill. So I would back test, I would journal, I would check what's going on in the market, understand, compare, contrast, watch ICT's videos and all those things. I was more focused on getting better at my skill and not making money, which is very difficult. Every human being wants to make money, they want to see results. Okay, so the way the market works is against human psychology. So why did I get here? I was telling you guys that the hedge funds they made the market in such a way that it against human psychology. So they made it for you to fail. So when they do like they push this market up, since they don't lose and they're the ones making the market buy up and down. So they buy here and when the market start going up, you now, many retail traders, which is you and I, they will not see this thing and will not say, Che, the market is going up. Oh. People that don't know how to trade, but they have access to money. I say the market is going up. Oh, let us buy here. To carry this their tool and put their stop loss here. Okay, hoping that price will just keep going up and possibly to extend that shit high. Then you know what these guys will do? These guys them do not sell here. Now, in reality, before you buy a shoe, somebody will have to sell the shoe to you before you can buy a shoe, right? Good. In For these guys in Forex, it's the same thing, but now it's secret. Meaning at this level, when these guys are really willing to buy, the market maker will sell to them. You know what selling to them means? In reality, yes, selling to them the shoe for them to buy is good. But remember, the seller is making profits from that shoe he sold. Now, the seller is the market makers in this game now. They will cash out from these people that are buying now. You know what? Now they will cash out. They will press sell button in their side because they are trading with trillions of dollars. Their orders in the market is making the market to move in that direction. They'll press sell here and the market start going down. And the retail traders now, this will be in their drawdown. Okay, they'll be seeing red on their account. Further to hit their stop loss. Once you hit their stop loss, these market makers will make the money. You get? And when he goes down like this, retail traders will be back again. He's going down. Let us sell. We put their stop loss there. And then the market makers will buy higher again. to destroy them, to lose money again to these people. People will pocket it again. That's what they keep doing. That's why you see the market move this like this. Okay, all these moves are called liquidity. Okay, when price goes up, returns goes up, it's intentional. They know what they're doing. That's why it's moving like that. Now, this way I drew it. Now you'll be like, why will somebody be so dumb to sell when you know that it's trend and it's just retracing? It's very easy for you to say, Abi, because I'm doing it very straightforward. Good. In reality, it's not straightforward. You that is talking, I think you're smart to lure you into without you knowing. Example, watch. This thing has been going down, for instance, now for a long time. It has been going down, down, up, down, retrace, down, retrace, down, retrace, down. Every single time it's trying to retrace up, people get deceived that it wants to what buy. As a beginner trader, look at this area now. Let's act like you're not seeing that side. That's why I left it here. After it has been, you now see how this is now trying to buy up. Every beginner trader wants to buy, wants to place a buy trade. But what happens? They dump it. Now they try raising it up again. People try to buy, they dump it. Make it range for a while, like without having any direction. Then pump it later. When you try to buy cover these things, they will dump it again. Then when you're trying to sell, think that it has changed to start going down again, they will pump it again. So is in reality it's very manipulative. So it takes a lot of skill to understand what they are doing for the trap. And that's why I used to tell people that it's very hard to learn Forex on your own or on YouTube. Just stop that bullshit and get the mentorship. But yes, that money is and people mentorship. You lose it in the market without learning nothing. If you lose it in the market without learning nothing, you're the one that lost. You're the one that is on the losing end. So that's the reason why the market moves up, down, up, down, up, down. It's being manipulated by people. So as it's moving like this, people are losing to it back to back because of its movement. So it's intentional, right? So which other question have I not answered again? Please, guys, you can remind me. All right. So sister one is talking. I want to show you guys the verse. Now we did buys. We did was one reason. I know I'll answer you guys. I'll answer you. Let me just explain this fact of time is going. We did buys, and when we did buys, we were saying that here's our stop loss, blah blah blah. I think we can understand that. Now the inverse is sales. Okay. When you're trying to sell, remember you're anticipating it to what to go down. Don't forget you're trying to sell. I think you're anticipating it to what to go down, obviously. So what happens is that okay, what happens is that since you're anticipating it to go down, you're going to use this to the inverse of this. The green is down now. This one the green is up. The inverse green is down. So you place your entry at the price line, which is this market price line, which is this black dotted line you see here. And you can put your stop loss anywhere. Let's say your stop loss is high there. Okay. And I'll teach you where to set as time goes on. But for now, let's just assume it's there. If this thing goes down inside this green side, my MT5 app, I'll be in profit. My other app, I'll be in profit. But if it start going up, it means it's going against my sell order. If it gets to the extreme end of this, my losses will be secured. Like my balance will reduce. If it keeps going down to the extreme end, my profits will be secured also. So that's why this is the type. This is for this one is for the sales. So some people have questions right here. Okay, the topic tonight is this understanding economic charts and going long, going short. Going long, going short. Going long means buy, short means sales. So I show them the use of of this of these tools you see here. This indicator, please stop coming late. Try as much as possible not to come late. It actually will finish you. Coming late will destabilize you. Because I will not go back to the beginning. You're on the losing end. You pay like everybody else. If you will miss out. And there is nothing I can do. You get so please, once it's 8:30, just try to be available. To save a lot of stress, except what I'm about to teach you, already know it and there's no problem. You're waiting for the more advanced side, there's no problem. But if you don't know it, don't shoot yourself. Don't try it. Make sure you're making. We only learn 3 times a week. It's not like it's every night. It's just 3 times. So make that time for it. Okay. Make that time for it. So somebody dropped. So hey, Google Meet will soon chase us. They say will soon chase us in 10 minutes. So anybody has questions? Equity, Idris. Equity. You made mention of equity. What is equity? That's what we're asking, right?
Yeah, I really didn't understand it much.
Okay, equity is your capital, and that's all. No stress. Your forex capital. That money that you funded, $50, $100 is your equity. No,
Yeah.
no, don't add any other complications to it. All right. So, any other question I've not answered,
Okay.
please.
Prop firm challenges.
Okay, you said you wanted to know about them.
Yes, you mentioned it in the video and you said you explained further.
Okay. Now, prop firms are companies that will fund you with large amount of money. Like me now, the capital I'm using to trade, how did I get it is prop firm. I was fucking broke, like too broke, like pitiable. Yet, so how did I get back on my feet? Feel me? Was from Profem. Now, Profem is a company that funds forex traders money to trade. The least money they fund to trade is $5,000, and $5,000 capital is enough. If you make 10% of $5,000, it's around $500. And you see how your currency is funny. $500 is around 350K a month. And we as forex traders, what I aim for every month is 10%. Okay, that's what I aim for every month. I don't force it. If I get it, I'll stop trading. But if I don't get it, I'll keep trading. So it's not like I want to force it. It's something that you can't control. It's business. And whatever business you're running, you cannot control how much you make at the end of the month. That's not forex. You can't control it. So if it comes in the first week of that month, me, I'll stop trading. I'll just be helping my students, sending them to down. I'll not leave my account. If it doesn't come, like I was close to it this month, though. I've made up to like 6% already. But then on which day is it? Friday last week, we had a loss. Had it been that day was a profit, we would have gotten to 8%. Maybe I'll need one more day to trade to get to 10% and I'll stop. So now it is back, it has reduced to 4%. So we keep trading. So whenever I get to 10%, is it maybe inside this week or next week? This week I've had a lot of stupid news. Inside next week, if my profits get to that, I'll start trading. So meaning 10% is an average or something that is very achievable for skilled forex trader to get. So now if they can fund you $5,000, the highest most prop firms, the highest they fund is $600,000. Okay, which is very very huge. That's around approximately, because I know that 100K is 75 million naira. So 600 is 75 million naira times six, right? So 10% of $600,000 is 60K dollars, and 60K dollars is something very huge in naira. You get. So that's why prop firm is just like the hope. Why you're here? You're not here to come and fund entire your small $100 account, $500 accounts, $300 accounts to trade. You will not get rich from doing that. There's no difference between you and somebody that is doing normal selling goods and services on the road. The only thing that makes you different is that you need big capital to make that forex money. So when you're skilled enough, when you've learned how this thing works very well, you will go. I will let you take on their challenges, but you will buy their accounts. Yes, the accounts are not expensive. Like that $5,000 account, which is at least cost $50. $50 around 40K or so. Now, when you purchase it, they'll test you, they'll give you demo accounts. Okay? If you can grow the demo account, most of them will tell you to do it like 8%. If you can do it in the first month, second month, or second challenge that will give you to do the same thing again, but now they just want you to make up to 5%. If you still do it again, they will give you the account. At the end of the month, you share the profit with them. You take 80%, they take what? You take 20%. That's how it works. Yes. That's how it works. So prop firms are companies that fund you. So if you don't know how to trade, you always fail as a rich. Always. That's why I tell people when you say, boss, I want to learn forex, how much I need to start? I say, leave this how much I need to start. Learn this thing. good enough, money will come. Meaning if you know how to trade very well, guy, you can even start from your family money, your own. Like any money that comes to your hand, you would know how to grow it. That's the kind of freedom you need for yourself when you know like okay, there's money with me, steadily I can grow it. Now at some point I used to tell my students that okay, you do $20 account. Okay, that was I used to tell them. In as much as I don't want you to go and start funding, I don't need you to do $100 funding on business. Those will not get you anywhere. Okay, because the profit is actually going to be small. I'll tell you, fund $20. $20 is 15,000 naira. You fund it, not now. You will get to that level after you have finished learning and you've said, see all these guys now are coming to this market. I tell them come back 9:30. These guys, these guys now, they're in that level whereby they are trading demo accounts. They know how the thing works to an extent. Let's say like 70%. Yeah. So they are still trading demo, sharpening their skills. When they sharpen their skills to a certain level, I will not tell them, oh yeah, fund your $20 accounts. Then they are still trading what I'm trading on, they're still following me. I think the same trade I'm taking. So if $20 account grows to 50, I'll not tell them, oh yeah, withdraw it, use that buy this profit. So that it's not even your money you're using to buy the profit. It's still what Forex gives to you. You get. That if you lose it, you know touch you, no pain you. And then if you win it, it's your luck also. But I don't think luck does not. Yes, you can use luck to win prop firm challenges. Just you're just lucky, you just win it. Yes, you can. But then you actually lose the funded account. If they fund you, that funding still have rules. You must not do this, you must not do this, you must not do that. If you pass with luck, time to collect payouts. Before you collect your first payouts, you fumble and you take the account from you. So you have to be skilled to be able to get funded, keep the account, get your first payouts and more payouts. That's just it. The
Okay, here we go. So we're going to be talking about technical analysis and fundamental analysis. So generally, I'm going to be talking about analysis as a whole, right? Forex analysis. So what do I mean by analysis? So I told you guys how to buy and sell on the forex market, what it means to buy, what it means to sell. If you buy and it goes up, you make profits. If you buy and it goes down, I explain all these things. But do you ask yourself, how can I know when to buy and when to sell on my own? How can I know when to buy and when to sell on my own? This is very, very important part of forex and also the toughest part of forex. This is what is going to make you stay to be a trader. This is what going to make you run and say, okay, I'm not, um, I'm not trading again. I can't cope. I can't cope. I can't do this. I can't do that. Right? These are one of the things that will make you stay, run analysis. And there are two types of analysis. We have the technical analysis and we have the fundamental analysis. The technical analysis is the act of using past history, okay? So I'm going to highlight it here, technical analysis, okay? In my boot camp last year, you're gonna be very conversant with this because analysis, because I took my time to explain this. Technical analysis is the act of using history, okay, past experiences on the charts to know when to buy or sell. Example, understanding how the chart moves, how it behaves. Technical analysis is the act of using what has happened before, right? All these things have happened before on the charts, how they behave, how they act. Example, something like this. This has happened before, that has happened before. Um, Look at how this is moving because it moves like this. Next time when I see that, I should do like this. I should buy here because at this moment it's sold here, it bought here. Right? That is what um, technical analysis meant. Also, sorry, that's what technical analysis is. Exactly what it is like history, training what has happened before on the charts, looking at chart patterns, understanding. So now that's technical analysis for you. That is the most popular way of trading, and it is divided into different concepts. In technical analysis, everybody has what they look for, what they see. This is learning how to know when to buy or sell. So everybody is different, right? So that's technical analysis, and we have fundamental analysis. And here we go, fundamental analysis. Fundamental analysis. In fundamental analysis, this is the use of news and real life experiences, like real life occurrences, to know when to buy or sell in the forex market. Example, when non-farm payroll is released, which is an NFP that happens, which is called NFP. It happens every first Friday of the month, called non-farm payroll. This is actually the employment rate of people in the US that are not in the agricultural sector, like people in other industries and the rest. How much percentage were they employed? How was the employment in the country and all of that? If it's low, the US dollar will be weak, to be weak. So what do you do to every US dollar? Every USD pair, you sell those ones that have their base currency to be USD, right? And you buy those ones that have their quote currency to be USD. So fundamental analysis actually tells you what to do, what to do, what to do. It's more complex, and we have fewer traders using fundamental analysis. Now there are some traders that combine the both. Like me, I use technical analysis 90% of technical, 10% of fundamental. I don't really do much of fundamentals, but I'll still have to explain fundamentals in this course, right? So these are the two major analyses we have in Forex. See you guys in the next video as we continue in technical analysis. Like, this video is going to be consisting of this because I major in technical analysis more, and with only technicals you can be profitable. With only fundamentals you can be profitable. With both also you can be profitable. Everything works, right? It depends on how you have been able to master it. See you guys in the next video. So let's get straight into it. Sorry for the poor network. Okay. All right. So the market is always going to be in these three phases. Out of these three phases, nothing else. Okay. The first phase is known as an uptrend. The second phase is known as a downtrend, and the third phase is known as a range. So an uptrend looks like this. And we have a range. It looks like this. Okay. Now I'm going to explain each and every one of them, and after explaining, I'll give instances. Oh, sorry. After explaining, I'll give instances on the real markets, how they look like. Okay, let me edit this a little. And I call it a range. And I call it a range. So let's talk about the uptrend. What is an uptrend? An uptrend is a phase or a season or a particular period of time when the market is moving in an upward direction. That is the layman understanding. An uptrend is a phase or a period, like there's a particular time when the market is moving towards the upside. So now, as you can understand its market structure, I repeat, there are three different kinds of phases in the market. So it's either the market is an uptrend, the market cannot be in an uptrend and in a downtrend at the same time. One has to be prevailing. I mean, in a particular time period. So let's say if you're in the daily time frame and the market is an uptrend, in that time frame, what we see is an uptrend market structure. In the 4-hour time frame, if we see a downtrend, what we see in that time frame is a downtrend market structure. Good. So trust me, in one time frame, two trends cannot be working at the same time. It's either one has transited into the other. So it's not like an uptrend and a downtrend can be in one time frame at the moment. In one time frame, no. One has transited to the other. It can be that it was in a downtrend before and now it has changed to an uptrend. So understanding how trend changes, I have the video in my channel, and go check for how to spot when a trend is changing. I especially did that video. Check in my channel. I'll put the link in my description. Okay, check. You will find out how to spot when a trend is changing. In that video, you can understand when an uptrend is swiftly changing into a downtrend. So we'll talk about that later. But for now, how do you know an uptrend? An uptrend is a market condition where price is going to the upside. Now, that's the layman understanding. Now, going in depth into this, how do you understand an uptrend? Now, uptrends can be very trickish. It could look like it's going up. Sorry, it could look like it's ranging, or it look like it's just choppy and everything, but trust me, it's still going up. How you can understand that better is using an algorithm, or not really an algorithm, using a formula. Okay, and this formula, it's simple to understand the formula. If we call here in this present phase of the market, let's look at this. I'm going to use my brush. Look at something like this. Here's my brush. So, okay, let's say we are looking at this part of the market. We are not seeing any other parts. Only what we see is just here, right? We are not seeing any other part. We're just seeing only here. All this side we are not seeing here. At this moment, this is the highest point in the market, and this is the lowest point in the market. Accepted. This is the highest point in the market. We're going to mention it as, I'm going to tag it as a high, capital letter H. And this is the lowest point in the market. And you tag it as capital letter L. Oh my God, what have I done? Okay, so I'll still continue to draw it the way it was. Okay, let's leave it there. So this point is seen as the highest point at this period of time. Now, note the period of time I'm talking about is where we cycled red with the brush tool, right? So I want to highlight my text and take it up a little. So right here, we call here a low, because this is actually the lowest point in the market at this period of time. So now, will you agree with me that any high higher than this high is known as a higher high? Would you agree that any high higher than this high is known as a higher high? Yes, a higher high, because it's higher than this previous high. So I'm going to tag here a HH, that stands for what? Higher high. So what impression am I trying to give you? I circle this place so that we can get our origin, like the beginning of the step. Because let's say we are climbing up a 10-step staircase, we must match the first step. So identifying the first step, I don't just want to call anywhere high and anywhere low, because you'll be confused that if I call here high and here low, then what about all these higher places? You say, okay, here should be the higher place. This area should be the higher place because it's the highest, and that should be the lowest. So I have to make you understand that let's forget this side for now. This circled place for now, what do we see as a high? Here. What do we see as low? Here, right? In this particular period of time. That's what I'm trying to make you understand. Okay. So let's continue. So after this high is created, if another high is created after this one, we see and we have come to the understanding that this is an uptrend because there is a higher high that has been created. Now let's see, what do we tag this point? Tag here what? A higher low, HL. Why is it a higher low? It's higher than the previous low, so it's a HL, higher low, higher high. So what do we tag this place again? This low, we tag it was what? Higher low under HL. Good. So we have low, high, higher low, higher high, higher low. Why is this still called a higher low? You would have been expecting maybe a higher low. No, it's called a higher low because if you say it's a higher low, it doesn't really make sense English wise, right? So we call here a higher low because it's higher than this, even this previous low. So higher low, higher low, higher high, higher high. So it keeps going up continuously. What do we call here? Still call here what? A higher high. So now, this formula I wrote, you can use this formula to identify an uptrend in any way, in any time, any market. Okay, just first of all, if the market is making higher highs and higher low, meaning it's forming high points like this, high apex points like this, and after it forms high apex point, it retraces and form another one, then we know that we are in an uptrend. If it forms a low, it forms a high, and then it breaks this previous high and start going up and curves again and start coming back to retest this point, right? You can call here a resistance and support for those of you that trade support and resistance, just so you can understand. This video is a beginner kind of video, so let's leave smart money out of this. So let's say this is a resistance that was broken and price is coming to retest on this resistance points. We cannot call it support. So resistance turn support. So as price broke it and returned to it, we understand that this is an uptrend prevailing. And I think I used to know is the high, high, and the rest. Okay. So now let's look at the opposite. Now this is just the inverse. Okay. Inverse is that at this period of time, let's assume we are seeing just here. Where is the lowest point? Here. And where is the highest point? Here. So, but it's depreciating. It's coming from an up. The highest point is coming from an up view. So that shows that we are depreciating, we are going down. So that's a downtrend. And what will be here? A low. At this point, this is the lowest point. So what do we call? So how do we know this is a downtrend? If price keeps pushing and breaks this low, it is going to form what we call a lower low. So we know that, okay, this is a downtrend prevailing, lower low. And here is going to be what? A lower high, LH. Understand why it's a lower high? It's a lower high because it's lower than the previous high. This is high, this is low, this is a lower low, and it's a lower high. The same thing continues. Here we have a what? A further lower, a further lower high right here. So lower high. So we have here as what? Even lower low, like it's lower than the previous lower low. So it's called it lower low. Same thing, same algorithm, same formula you follow, right? That's understanding market structure. Market structure means understanding what the market is doing. You're not taking any trades here. I'm not teaching you how to analyze anything. I'm just trying to teach you how to understand the overall market structure. Because the rule says if the market is in an uptrend, do not look for sales. Look for only buys. I don't say take buys on anyway. Look for buying opportunities. Look for. And we say if the market is in a downtrend, do not look for buys. Look for only selling opportunities. I'm not saying you should just sell from anywhere. Look for selling opportunities. And how to look for those selling opportunities, you would learn that in another video, but not in this video. This video is strictly for understanding market structure. So let's talk about the range. Now, the range is a scenario where, sorry, the range is a scenario where price is not going up and it's not going down. Price is just in a certain confinement, going up, going down, just like the way Euro USD is right now. Euro USD is actually ranging with some little spike up and the rest, but is in a particular range, particular area for some time. Is it tradable? Very much tradable. In a range, you can look for buys and sells. Depends on you. But if you're down here, you know you're looking for buys, go up here. If you're up here, you know you're looking for sales. So you're trying to sell high and buy low. You shouldn't be caught selling in the middle or selling down. Understand? Because you can get trapped. But knowing when to understand where you're at the top of the range you want to sell and everything needs some other conferences, and you get them in other videos I'm going to make. So this is Euro USD. Oops, I missed this sell. Was I to my channel that I was going to sell this shit? Oh God, how did I miss this? Oh, well, we move. Missed it. The most important thing that we're correct about the trade. So, yeah, I think there's some kind of other block here. Break structure. Okay. 7 o'clock. Okay. One of a kind. Something hard. So let's look at an example for an uptrend. An example for an uptrend. So, an example for an uptrend, I'm going to give you a GU chart, GU 4-hour chart. What do you see? You see price moving in an upward direction, first of all. So we are sure that this is upward direction. We are sure. As you can see, the arrow is going up. So how do we identify the higher highs and higher low? For beginners, it's simple. Make use of your path 2. But for me, I can see where the higher highs and higher lows are. But for beginners, you can make use of your path 2 to your very very used to understanding this with your eyes and rest. So I'm going to use my path to map out where I see how like the movement of the market, right? I need to map it out. So I'm mapping it out here. Here. So this is I should increase my make it thicker. Let's just continue. I hope you can see it. So right here is a low. This is a high. This is a higher low. This is a higher high because it's higher than the previous high. And this is a higher low. And this is not a higher high. Look at it carefully. It's an equal high, what we call liquidity, right? It's an equal high. But if you see an equal high, doesn't mean the trend is coming to an end. No, because the formula is still prevalent on the other side. Meaning, if here is carrying a sorry, here is carrying a H high, HH. Here is not carrying a HH. Yes, you can say there's something fishy, but this is still an uptrend as long as this is higher low. So low, high, This is what? A higher low. This is a higher high. This is a higher low. This is not, this is an equal high, EH. So what do we have on that? A higher low. So because it's a higher low, you still consider this an uptrend. Where we can say this has changed totally from an uptrend to a downtrend is when this guy is now equal with this guy, which is equal high. And this guy becomes a lower low, like this. Lower low means it's not lower than this low. Call it a lower low. When I say, okay, well, price has started changing, it's no more in an uptrend, we are now getting into what? A downtrend. Do you understand? So at this, we understand that, okay, this is a downtrend we are coming into. Like, we are sure that this is a downtrend because price has broken structure, BOS has broken structure to this phase. So what we're looking for now is sales because we know we're in a downtrend. We'll be very careful that, okay, uptrend has come to an end. But right here, we are in an uptrend. Uptrend has not come to an end. So because here the higher low, we're saying an uptrend. As you can see, price has gone to make even a higher high. So you know that the uptrend is prevalent. That's an example, a very good example of an uptrend. But let's look at an example of a downtrend. This is USD some time ago in 2021 November. Yeah. So what do we see here? We see price, first of all, price moving to the downside. So bear looking at it, you know that this is an uptrend. But to put in the formula I gave you, in case why you have to use that formula is in a scenario when it's very, 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 very confusing and choppy. When I mean choppy, a scenario like this, everything is just gathered together. You understand that even if it's gathered together, I know where the price is going to. The price is actually in a downtrend, right? Like it can help you spot when a trend is changing. Also, that's why you need to stay with the formula. It helps you spot when a trend is changing. That's the most even important part. Because you see that okay, a lower low did not form. Instead, something else is forming. Okay, we are not more in an uptrend. But if you're not looking at your eyes, you might still be confused, just like this now. I'm using this choppy area to make illustration. Let's leave this side. Let me make this higher side to make illustration. So you see price moving in the downside. This is a previous high and this is a low. So what do we have here? This low is no lower than this low. But this high is lower than this high. So uptrend is working. Right? It's just being very deceptive because it's choppy. But as long as you know that this is a lower high, yes, a downtrend is active. Only where we can say that this is an uptrend is when it has made a higher high and a higher low. They must work together. A higher high and a higher low. But as long as we have a lower high, and this low is not lower than this low, we accept. But this is a lower high, we get a downtrend because even it went further to create what a lower low downtrend. Okay, so we see price do this. We are still in a downtrend. See price do this. We are still in a downtrend. Now, when we see price do this, okay, this has gone higher than the previous. This is the previous low. Price has gone higher than the previous low, creating a higher high. Right? What do we call this? We say, okay, an uptrend has entered because this high has been broken. So what do we look to see? We look to see a retracement to form what? A higher low, which is this. This low is higher. Then we see price has changed direction. As you can see, this is a higher low and this is a higher higher, everything. So that's the reason for this formula, to understand when trend is changing most times. But understanding this, that look at this formula, okay, in case so I won't forget, I can snap it or screenshot whatever you're using to watch this video, just use it. Okay, Euro USD, you have it in Euro USD. Okay, so where is it? Oh my god, I can't find it. Okay, I'll find it. It's up there. So do well to do a screenshot of this formula you see here. Do a screenshot of it. All right. Do a screenshot of it. Okay, so boom. Let's talk about the range. A quick one about the range. Okay, so a pure range is something we can look at as this. It's a pure range. Yes, call this a range. Look at what is in this rectangle. See its price up, down, up, down, up, down. It's not going to the upside, it's not going to the downside, it's just in a confined region. It's known as a range. So
The first market structure here is uptrend. You feel me? The second here is range, and the third is a downtrend. Okay. So going to the uptrend, I drew these lines more like a skeletal frame to show you what a typical uptrend market looks like. And I also drew this skeletal frame to show you what a typical range market looks like. And this is a downtrend. Now, an uptrend, as the name implies, it's pointing up. The range is not pointing in any specific direction, it's moving sideways. The downtrend is pointing down. So this is an uptrend because what we see pricing is that price will create a high, create a low. The next high will be higher than the previous high, meaning it's progressively going up. So even as it's moving in wavy, in waves rather, it's showing that it's progressive, it's going higher. Look at the range. The range is not going either higher or lower, it's just moving in waves. But the uptrend is moving in waves. Let me use this. Okay, the uptrend is moving in waves, but each high surpasses the previous high. When this pulled back, we call this a retracement. It went higher, and that higher move is called an impulse. And guess what? The impulse move took out the previous high. So what is happening is price will create a high, and we create a higher high, and we create a higher high. So where's the best way to mark out an uptrend or to represent an uptrend on your chart? Whenever a high gets taken out, you draw a line to mark it. So this high took out this high, as you can see. So here I am using this green line to mark the boundary where it crossed. So I'm going to call that a break of structure, BOS. Okay. That's going to be called a BOS. Why? Break of structure when a high is broken. That's the structure. It was broken. And here another BOS when this high was taken out. Okay. As easy as that. Does a range have a BOS? No, it does not, because price is not breaking any high and no lows are being broken. We'll come to the downtrend. The same thing. The overall direction is down. In this case, highs are not getting taken out, right? The lows are being taken out. Rather, here the highs are being taken out. The highs are being taken out. Here the lows are the ones being taken out. So if I'm trying to draw this or to mark up my charts representing it as a downtrend, I have to draw my break of structure line after each low that gets taken out. After each low that gets taken out. So this is more like the inverse of the uptrend. Okay, so let's go straight into real life charts to explain this further. All right, so here we have an uptrend market. Okay, an uptrend market. This is GBP USD 3-minute time frame. So uptrend market, you see this high was taken out. That's when it's identified that it's an uptrend market. Another high was taken out. Can you see?
It's an uptrend market. Another high was taken out. Another high was taken out. Another high was taken out. So you can see how it's moving, just like the former schematic I drew, or the former skeletal drawing I did. Pull back, go up, pull back, go up, pull back, keeps going up, just like that. This is called an uptrend market. So an example like this is going to show a downtrend market rather. So we have this low taken out. You see it, this low taken out, very tiny but significant. This low taken out. Okay, this low taken out. As you can see, it's a complete downtrend as we move this way, this way, this way, this way, this way, this way. So as you can see, this is how price changed from an uptrend to a downtrend. Perfect scenario. So looking for a rangy market, we're going to use this as an example. Okay, I'm going to draw a rectangle to highlight this, and this is an example of a rangy market condition. So as you can see, price right here is not moving anywhere. A smaller scale of range market is known as consolidation, but if it's larger, it's known as the range. Okay, so if you see how price is moving without any definite direction, price is moving without any definite direction, just sideways, sideways, sideways. Okay, goes up, comes down, goes up, comes down. It's not really going up, it's not really going down. Okay, so that is an example of a range. So if you found this video helpful, click the like button and subscribe to the channel. The next video coming is going to explain these concepts better. Just be patient with the bootcamp and follow it step by step. Peace out. All right, so what's the use of Fibonacci? As you can see on my screen, I have a Fibonacci drawn very clearly on my screen. So some of us know what Fibonacci is and the use of Fibonacci in trading, how it's used in calculating retracement. I mean the use of Fibonacci retracement to rather how it's used in calculating retracement, why some of us do not know. So I'm going to run through the importance or the use of Fibonacci first of all. And before that, I'm going to like you to copy the settings of my Fibonacci so that you can have your own settings like mine. So here we go. These are my settings. Do a screenshot and then do another screenshot. I just slide it down. Okay. So let's get straight. The use of Fibonacci is very important in trading because it helps us measure every retracement. So our last video on day one of our bootcamp, was showing us that we had three different market structure. We had the uptrend and we had the range that's going sideways that has no direction, and also we had the downtrend. Okay, so the nature of the market is that it moves in waves. The market moves in waves, and if the market moves in waves, there always has to be two different swings on every structure. What am I saying? Two different swings is the real swing that shows the real direction of the market. This, the counter trend, also known as retracement. The real swing, also known as impulse, happens. So I'm saying impulse, retracement, impulse, retracement, impulse, retracement. The impulse are always longer, always more precise, always more aggressive, because this is generally an uptrend market. So because it's an uptrend market, any swing that points up goes higher, faster, and more precise. The retracements are always slower, but then it goes back up. So since the market moves in waves like this, the question is,
if you were to trade this market, everybody knows the trend is your friend. In an uptrend, buy. In a downtrend, sell. So if you are going to buy this market, the best points to get involved in buying this market, these are the best points here. You get involved in buying this. These are the best points to buy because you want to catch the real swing. You don't want to trade wrongly in the retracement. You want to catch when the swing, when the buy momentum is coming in. That's what you want to buy. That's what you want to buy. That's what you want to buy when the buy momentum is starting. So the question is, if you're supposed to buy in all these points, how do you know when this retracement is over? Because in real life market, sometimes it retraces like this, sometimes it retraces like this, sometimes it retraces like this. So when should you buy? When is the right time to take a buy? This is just a representation of um of the market structure in a very easy format, simplest form. In the real market, everything is more trickish and choppy. So the question is, how do you know when to buy at these levels? Because now it's showing that it has already happened. In the case where you haven't seen this, for instance, okay, you haven't seen this, for instance, price is still here. You don't know if it's going to go down. You don't know if it's going to go up immediately. If you don't know if it's going to, it's not going to get to this circle. Maybe from here it's going to go up. So that's supposed to be the question you all need to ask. When are we going to be comfortable buying? So now this is where Fibonacci retracement comes in. So when price move like this, the first impulse, and it's retracing back down, this is where you draw your Fibonacci from the low of the impulse to the high. And when you do that, you want to buy when price has been able to retrace at least below the 50% level. So if you look at my Fibonacci very well, you find out that the anchor is strange, meaning I remove the lines for the anchor. Here you just see a dot, and here you just see a dot. Okay, normally they are supposed to be lines, but I removed it because I'm trying to make my chart as clean as possible. So if you took my settings, your fib is going to look like mine. I care about the red line, which is 0.5%, and all these black lines. That's what I care about. But I care about this, especially the red line. So that's what I want to see, basically. So most price action traders have their Fibonacci levels like 50, 61.8. Remember, 61.8 is approximately 62. So my Fibonacci is different a little. This is, instead of 50 is 0.5. Instead of 61.8 is 0.62. Instead of 70.5, this is 0.705. Instead of 79.0, this is 0.79. So it's still the same thing, but it's just a little different. But the half of the Fibonacci 0.5, which is the 50 level, remains the half. Okay, so if price is able to come back, we trace back into this, we look to buy, because anything from here, the price is ready to go up. It will go down a little and start going back up, or it will go, but it should be at least after this red line has been tapped before we are ready to see a new high created. Okay, so how to use the Fibonacci: once a high is being broken, you cannot use the same Fibonacci arrangement to determine the next retracement. Okay, so once a high is being broken, the next retracement is going to need you to redraw your Fibonacci. So I'm going to erase this. And I'm going to draw it again from here to the top. A new drawing, because it's a new swing. Okay, this first swing has been completed. Since it has broken this high, we have to draw a new one from this low to this high. Okay, from this low to this high. And when it comes to the red line, we're looking for buys again or below the red line. Now, why is this so? This is so because smart money always want to buy low and sell high. Now, what do I mean by buying low and sell high? So I'm going to mark this as a range, this low and this high. What they do is they find the equilibrium in this range, meaning exactly half of the range. And to find the equilibrium, which is half of the range, you have to mark, use a Fibonacci and mark out 50% of it. This is how you get an accurate half of the range. So this is 50% Fibonacci, and I kept the line on it. So they believe, or it's not they believe, this is what they do every single day. This is called a premium and below is called the discount. All right, I'm going to encourage this fonts a little. All right, so premium discount. What do they mean by premium? What do they mean by discount? Now, in our everyday life economics, if I want to do a shoe business, I must buy the shoe at a cheaper price and sell it more expensive. This is the idea of discount and premium. I must buy the shoe at a discount price. Let's say $1,000, and when I want to sell the shoe, I sell it at $2,000. That's a premium price. So it means you must sell at premium and you must buy at discount for you to make profit in your business. It's the same here in Forex, meaning whenever price is above the 50%, it's in premium. So smart money guys, not we are smart money concept traders, SMC. Smart money are the market makers. So what do they do? They sell once it's here and it's not um up to the 50% Fibonacci. Their orders move the market. So if they sell this because of them, because of the large orders, the price starts dropping. So because they're in the premium zone, they'll sell their way down here. And then when they get to the discount zone, they take off their buys straight from here. Are you seeing? So that is the reason why you see the trend moves in waves. Impulse retracement, because they are working with premium and discount levels. Okay. So is this the same for a downtrend? Absolutely the same. So let me do the same thing for a downtrend market. Okay, so for a downtrend market, if price is doing this, so this is the first leg of the move, and this is the retracement, and this is the result. The first leg of the move is the impulse. Remember, it's a downtrend. This is what is facing down. This is a minor retracement or a counter trend. This is another main move. So if I want to calculate where should I sell from, if I draw my fib from that high to this low, remember, if you're drawing your fib on a downtrend, you have to draw it in this direction. Look at this arrow. You have to draw it down from up to down. Why? Because it's a downtrend. So you pin your fib from up, draw it down. If it's an uptrend, you draw it from bottom to top. I get me. Why? Let it be able to show in this up direction. You know what I mean? Good. So up direction for uptrend fib or fib long, you must well call it, and down direction for downtrend fib or fib short, as you can call it. So the reason why price retraces up to the 50% of the Fibonacci or the range before dropping is because here is known as premium and here is known as what? Discount. So guess what? When this first starts, when this price first pulls back down, before the retracement happen, they see that price has pulled back into discount. So the what? Buy it back. Market makers will buy it back right up to this 50% or slight or above. Just making sure it enters the premium area. And then remember, you must sell at the premium. Then they sell. Markets are dumping again. Now they repeat the same process. Now it has broken this low. Remember, whenever price breaks a low, the old Fibonacci becomes useless. You have to join a new one. Okay, so I'm drawing my new Fibonacci to calculate the next retracement. I want to get into these sales. I can't sell here. I can't sell while it's moving. I must sell when it has retraced so I can catch a new impulse move, just like how I sold here and caught the new impulse move, right? So if I draw my fib from top here, see I pin it to this level, my range has changed because this is now the high and this is now the new low and this is now half of the range. Everything has changed. So in as much as we are sitting at the moment in discount, smart money will have to buy this up to this level so I can get a premium. Remember, you must buy in discount, buy low, sell high. Buy in discount when it gets to premium, they short it keeps going down. This is how an ideal downtrend occurs in the market. So let's go forward into the live charts and let me show you how this works for a downtrend and uptrend. Now we see a clean downtrend scenario, as you can see on GBP USD 15 minutes time frame. Okay, so this trend started here, and when it broke these lows like this, it broke this too. Okay, when it broke these lows, if you are going to get involved selling this, you're going to sell it from here. You're going to draw your fib. Now, if you're drawing your fib, you don't have to include the wicks of your fib. You just have to draw it from the body right here of the candles. So the body here. So if you see in this scenario, you see price retraced, but not up to the red line, but it dumped. It happens sometimes, but not all the time. But most of the time, it retraces back at least to the red line before dropping. So if you are going to trade this, you are already going to miss the move. Okay, you are already going to miss this whole sell drop. But then you're going to wait for another time when the trend has a break of structure, just like this. It broke this low again, and allow opportunity to draw your fib. So I'm canceling the first fib because it's not irrelevant because we broke a low, and I'm going to try here from this high to this low. And this is a perfect example of what I meant. So you can see the high here and the low here. Remember, from the body down to the body. You see how price retraced nicely into the red line and slightly above, left rejection start falling. This was the area to short. All of this area was where you could sell. And you see how it dropped massively. Okay. I'm going to show you an example again for a downtrend market. So here again, price was still going down. Where did we break structure? This was broken. Structure was broken here. Okay. When structure was broken there, we needed a retracement so I can short. So you draw your fib from the top here to the bottom. Where's the bottom? Remember, this is the bottom. This is the top. This is the bottom. And did you see retracement? Yes, price retraced to the red line. Enough opportunity before you could what? Short. That's the second example for a downtrend. The third example rather. So what about an uptrend? Price has been bearish.
for this long. But when price flipped bullish was when there was a change of character around here. So this was a change of character. Change of character meaning price was able to shift or flip from bearish to bullish. Why? Instead of this to go, this was supposed to keep going down to clear this low to continue the bearish move, but it refused. Went to create a high, created a low, and broke the high. This shows that price has been able to flip bullish. So if price has been able to flip bullish this way, we have to be able to draw our fib in a bullish way to catch the retracement and catch a big move. So how do you draw fib long? From the low to the high. Okay, and guess what? This is the retracement. It's went to the red line and even below left rejections here. This is enough opportunity for you to accumulate your buys, and you see price flew up. So let's get to another example for the buys for bulls, right? This is an uptrend scenario again, where price is breaking highs, going up, and price just broke this high. A new opportunity to draw fib, to know when to get involved in longs. So from this low to this high, from the low to the high, this I draw my fib, and you see the retracement back to the red line and even below, and you see where you have accumulated your long, and you see how price went up. Okay, this is how it works. So this is all about Fibonacci for now. So look forward to seeing you watch next video. Okay, so make sure you follow up this bootcamp, like this video, and subscribe to the channel if you really found this helpful. Peace out, guys.